Okay, guys, Palantir, they just reported. Obviously, we're here to analyze the company now and talk about it. This is a company that we've had a lot of drama about in the YouTube community about Palantir. And guys, I'm not going to lie to you. My views have changed a little bit on Palantir over time. So stay through the end of the video. We're going to talk about a lot of things on Palantir, news, bull cases, bear cases, 8 pillars, analyst estimates, and then we're going to finish it off with running our stock analyzer tool, because I'm sure you're out there wondering, great, I like the company, but how do I determine the price to pay for the company? That's what our software does for you. So stick around to the very end. There's going to be something here for beginners, something here for more advanced investors. No matter what spectrum, where you are in the spectrum, stick with us because it'll help you learn more about investing, which is the goal here for this channel. We want to teach a process. So Palantir, down 8.6% today. Year to date, it is up 156%. Mo, why are you smiling?
That's crazy.
It is crazy. It's a $34.5 billion market cap, which means you want to buy every share outstanding. This would have cost you. But Mo, look at this. Their enterprise value, which means the entire market cap, less all their cash and debt, is actually lower. So they have a great cash position in the business. They've been cash flow positive for what, 10 quarters in a row now or something like that?
10 or 11 now.
It's crazy, guys. So they have, the last year, they've had $346 million in free cash flow, but their earnings are still negative, okay? So they're probably deducting a lot of their software costs as time goes on, but the cash flow is showing very big jumps. Because remember, when you outlay the cash flow to develop the software when you get a new client, the government doesn't just let you deduct that software immediately. There are rules involved with that. So that's why with some software companies, as they're growing, it's hard to kind of get engaged. Now, I will say this. This is something I want to look at. The price to sales ratio is 17.4. This is a very easy metric. What it does is it takes the market cap and divides it by the sales. Okay, 17.4. Now, this is high for a software business. If you want to look at Microsoft, for example, Microsoft's price to sales ratio is 11.5, and we don't think Microsoft is worth what it's currently selling for. However, does that mean that this number is too high? Well, guys, Palantir is growing like crazy. Yeah. Like crazy. You should be willing to pay a high premium for growing companies with a high return on invested capital. Now, the way return on invested capital is calculated, it's going to be a little affected here. So I'm not even going to look at this metric. I'm not even worried about the return on invested capital for Palantir. All I know is they're growing like crazy, they're getting more clients, and they're doing a great job. What do? They use data to basically solve businesses and governments' problems. That's it. It's a very generic thing, but that's their goal here, is to sell software to companies and governments that need to figure out a way to solve their problems using the data. So Mo, go over some of these things that you saw in the report.
Well, speaking of growing like crazy, I found this to be very weird. Revenue grew year over year at 13%.
That is kind of low.
Don't you think that's weird?
I would have thought that'd be higher.
Because even analysts were expecting 30+% in a lot of cases. So when I saw that yesterday, actually it caught me off guard. I was not expecting to see that because everything else seemed pretty good except for their commercial revenue grew 10%. Government revenue grew 15%. I like to see that this commercial revenue is continuing
so here's
to grow.
the reason why. You ready? Mm-hmm. Go one more down from government revenue. Here. Customer count through 30. So they talked about this in the last few quarters. They said, listen, we want to grow our customers, which means we have to have an average sales can be a lot lower. So I think that's the big reason
for this.
Yes, they're not growing revenue as much because they're trying to focus on getting more customers at a lower entry point of price.
What do you think about that strategy? This early on.
To me, yeah, I think that's a weird one for me.
It's funny because you would see these companies they just want to grow revenue. And that almost seems like it's something for as they get a little bit more mature.
Yeah, because I look at our software here on Everything Money, right? Mm-hmm. And I sit there and say, okay, what's the goal for our software? The goal for our software is to have more exclusive community, and how are we going to do that? We're going to make the software better and we're going to increase the price. Right? Mm-hmm. We'd rather have less growth, but to have more dedicated people. Mm-hmm. This to me seems like maybe they're trying to appeal a little bit too much to the investors, to the market, I mean.
Yeah.
So of course, guys, they just announced a $1 billion stock buyback. Yep. I just tweeted about this this morning. And I sat there and said, bluntly, what the f***?
Why?
Why are you doing this?
Why?
First off, you're expensive.
It is so weird.
First off, you're expensive. Secondly, if you're a fast-growing company like you say you are, you should keep that $1 billion and use it to grow your revenue and profit and cash flow. Couple this with two quarters ago, they conveniently beat by 1 penny per share, and the way in which they beat was very suspect. So remember, guys, if you're new, even your advanced investors, you got to remember, companies are capable of manipulating their numbers. And when we dove into the data a little bit, what we found through Dalton, our analyst, was he sat there and said, wait a second, there was an asset that wasn't on the books, suddenly it was on the books, they marked it up conveniently enough just to beat by 1 penny per share. Guys, go ahead.
It's that coupled with this, like all of these things. This is just a very weird company to me.
Yeah.
Like not going after revenue growth, going after
customer growth.
It's weird. Everything is weird.
So, okay, it is weird. Let's go see. Okay, this is our 8 pillars for the company. And guys, remember, if you have our software, you can get up to 12 different pillars. You can customize your pillars completely to what matters to you. But here on the regular one, on our normal one, I mean, it's yeah, I get this. This shows a fast-growing company, no debt. This actually be a check mark here because it actually is no debt. So there's 4 check marks, and they're good check marks. But look at this. Shares outstanding. Guys, what they're doing here is diluting you. So if you bought the stock, if you own the stock, years ago, you're sitting there and now you're sharing almost triple the revenue and profit with everybody else. Almost triple. They've diluted you as an owner. So if there were 10 shares outstanding when you bought and you owned 1, now there are 28 shares outstanding, you still own 1. So now instead of splitting your profit and cash flow with 9 other investors, it's now split with 27 other investors for you doing nothing. Go ahead, Mo.
In 2019, they had, let's call it 714 million shares outstanding. And today they have 2.06 billion.
Guys, I hate that. I absolutely hate that. There's a lot of bad things here that I just don't like. But let's go to analyst estimates.
Yeah, let's see.
Oh my God, I'm actually surprised by this. I thought it'd be much faster growth than this.
Exactly.
Wow.
So in the earnings video he put out, a lot of people were saying like, "Oh, you guys, you're salty about this. You missed the boat." For me, I just don't want to own this company.
I'm going to tell you guys something right now.
That's the thing.
I'm going to tell you something right now. I never get salty about not owning a stock.
And
ever.
Just because.
Ever. This could become a $1 trillion company if I stick to the right process. That's what's going to matter to me.
Yeah.
And that's what we're trying to teach here.
Yeah.
You got to get rid of FOMO. You can't have your FOMO.
This is a fun company to talk about, a really good video to make on YouTube. It's very good from an educational purpose, but I have no interest in owning this.
In full disclosure, do I think is this a high risk, high reward potential? 100%. Absolutely.
Yep. Doesn't mean I need to be on the train, though.
Doesn't mean I need to be on the train. And for me, if it doesn't fit my criteria, it doesn't fit my criteria. But doesn't mean we're not going to still look at it as a way of learning about the way in which this company looks.
This is a great way to learn, especially about management.
And because the stock price gets cheap enough, we're not going to sit there and say, listen, the stock price is cheap enough. There's still, because it's hard to, even though they're manipulating their earnings, it's hard to manipulate cash flow.
Yeah.
And that's one thing I give major credit to the company. They're generating more and more cash flow every single quarter. And more power to them. That's awesome. And that is something that focus on. I just don't like these little games that are being played with a stock buyback and beating by 1 penny. It's like
every quarter there's something.
If I were on that board, I mean, I just want to be like, guys, what are you doing?
Yeah.
Why are you buying back shares? I would look at them and say, do you not think that you guys have a lot of growth potential? Absolutely. Then why are you wasting your time buying back $1 billion worth of shares? All right, let's go to our stock analyzer tool so we can actually determine what price to pay for this company. Now remember, this tool amongst all the other tools in our software, all here available. Guys, this is everything. 10,000 companies in your phone, right there. Steve Jobs always talked about 1,000 songs in your pocket. It's 10,000 companies in your pocket, a way to analyze them, way to talk about the community, way to do everything here. You have our community chat here with thousands of investors. It's awesome. It's great. Our stock analyzer tool was used over 2 million times since we debuted it because it's just a way of taking the data that you've determined and telling you what price you should pay based on that. All right. So let's go sit here and we're going to do a 10-year analysis. You can do 1 to 20. Mo, give me some revenue growth numbers for this company.
I'm going to go with 8, 16, and 24.
So very wide, but I love it. Go ahead, Mo.
I will say my previous numbers back in May were 10, 18, and 31 or something. But after seeing that report and seeing this new strategy, I'm going to bring it down.
And the other thing, guys, is with the smaller companies that are new, you're probably going to have much wider ranges. I mean, it's not like Microsoft where it's like, hey, Microsoft is probably going to grow in a very tight, narrow space. But Palantir could be, like Mo said, okay, it's going to be 8%, or it could be all of a sudden something happens and they grow like crazy, 24% revenue growth. Now, what's 24% revenue growth for 10 years?
They did.
That would be 8.6 times their revenue. Okay, I could see that happening. Is it going to be hard? Absolutely, it's going to be hard. Now, what about profit margin, Mo? Since we don't have a normal profit margin because they haven't had it, but I would look at their free cash flow margin last year of 17% and kind of guide off that.
So I was thinking 15, 25, and 35. I just don't know where they could fall, but it's software.
Can I modify it just slightly?
Sure.
15, 22 and a half, and 30.
Okay.
So I'm going to do that for both free cash flow and profit margin. Okay. As they grow with a high gross margin, that means every extra dollar they sell, a big chunk of that is going right to the bottom line. As they grow higher and higher, that bottom line profit margin and free cash flow should jump up. And they already did 17.4%. So I think doing 15 is a very conservative number. Now, Mo, PE in 10 years, the company's going to be a lot more mature, but probably have a very big, stable control in that market.
How about 16, 20, and 24?
I like
24 seems high, but if they can hit those revenue numbers and profit margin numbers, I mean.
And part of the reason why we go really high here, guys, is we want to sit there and see, okay, well, how extreme, is this an extreme number or not? Maybe this, if all these high assumptions come in and the stock price says $12, you just got to wait. Because it's like, listen, we put these really ridiculous numbers in here. The stock's at 16 and it's showing a value of 12.
Yeah.
So finally, for a desired annual return, what's our margin of safety? What return do you want? As you make higher and higher assumptions, you should want a higher return because it's less likely to happen. So you need a higher margin of safety. So Mo, give it to me.
How about 12, 14, and 16?
I'm actually going to go 12. I'm actually going to go 13, 15, and 17.
Okay. More margin of safety, bigger risk.
Actually, you know what? I think 13, 16, and 19.
Okay.
Because let's hit the analyze button. Now remember, guys, stay with me throughout the rest of this video. We're going to talk about these numbers and explain what they mean. We're here to teach you how to fish. We want to make you a great investor. We're not here just to hand you stock and say, go buy this. That's completely unethical, and it's a terrible idea. We want you to be able to make your own decisions. So we hit the analyze button. Boom, scroll down. Oh my God, look at that.
Oh my God, $12.
A low of 234, a high of 12, middle of 584. And I always said, even when the stock was at 45 and that idiot in Russia or wherever he's from said the stock's going to the moon, I was like, I might be interested at $5. And it never hit $5. So if you pay today's price and the lowest assumptions occur, you're going to lose about 10% a year. Pay today's price, the middle assumptions occur, you're going to make about 3%. And if the highest assumptions occur, 15%. Guys, to me, banking on the high assumptions isn't worth it.
And this all assumes profit today.
And this all assumes profit today. Well, we had the free cash flow, which is good.
That's true.
And you have to get past the whole, they're stupid with $1 billion buybacks and all that stuff.
Yep.
Guys, everythingmoney.com, subscribe to the software. It'll make you a better investor. You can see from this right here how it helps you. Take care.